Hey, welcome. Today, we are going to decode the language of money. We're breaking down some of the most common financial terms you'll run into so you can walk into the world of investing feeling totally confident. Let's get right to it.
You ever find yourself reading an article, maybe watching the news, and words like dividend, ETF, or bull market just kind of fly past your head, and you're left thinking, what does that even mean? Trust me, you are not alone. It can seriously feel like you're trying to learn a whole new language.
Well, that's exactly what we're going to do today. Think of us as your personal translator. The whole point here is to demystify all these terms, clear up the confusion, and really just empower you with this knowledge.
So here's our game plan. First, we'll look at why finance feels like its own language. Then, we'll get into the basic building blocks of your own finances. From there, we'll explore different ways to invest, figure out how to read the market's moods, and cover some smart strategies, all leading up to the big one, financial freedom.
Okay, so let's jump right in with the essentials. And don't think of this as some boring vocabulary list from school. This is about learning the key words you need to speak a new and honestly a very powerful language, the language of finance.
And the absolute foundation of that language starts right here, with your personal financial building blocks. These are the fundamentals, and it all boils down to three really simple ideas: what you own, what you owe, and what it's all worth when you put it all together.
And this pretty much shows you the two sides of that coin perfectly. On one side, you've got your assets. These are the valuable things you own, like a house or stocks in a company. And on the other side, liabilities. That's the money you owe to other people, like a mortgage or that credit card bill. See? Pretty straightforward. So what happens when you put those two things together? Well, that gives you equity. Equity is the part of an asset that's truly 100% yours. The classic example is your house. Let's say it's worth $300,000, but you still have a $200,000 mortgage. That means you have $100,000 in equity. That's your slice of the pie. Now, no matter if we're talking about assets or liabilities, you're always going to hear these two words, principal and interest. The principal is just the starting pot of money, the original loan amount or the first check you wrote for an investment. And interest, that's the extra bit. It's either the fee you pay to borrow the principal or it's the reward you get for investing it.
Okay, so we've got the building blocks down. Now for the fun part. Let's talk about the actual tools you can use to put that money to work and really start building your wealth. The two big ones you'll always hear about are stocks and bonds. And what I love about this is how simple it makes the difference. When you buy a stock, you're literally buying a tiny piece of a company. You become a part owner. But with a bond, you're not an owner, you're a lender. You're giving a loan to a company or even the government, and they promise to pay you back with interest. Owner versus lender. That's the key.
But what if you don't want to spend all your time picking out individual stocks or bonds? Well, that's where funds come in. You can think of a fund as a pre-made basket of investments. Instead of buying one thing, you're buying a whole bunch at once. The common ones you'll hear about are ETFs, mutual funds, and index funds. They all just make investing a lot simpler and more diversified. Honestly, they're a fantastic way to get your feet wet.
So, you've got the tools, but what about the playing field? The market has moods. It goes up, it goes down. And understanding these swings is the secret to staying cool and making smart moves.
I bet you've heard these terms thrown around. A bull market is when everything's generally heading up. The economy's feeling good, investors are optimistic, and prices are climbing. Just think of a bull thrusting its horns up. And the opposite? That's a bear market. Prices are falling, usually by 20% or more, and everyone's feeling pretty pessimistic. Think of a bear swiping its big paws down.
So how do we measure just how wild those market swings are? That's where volatility comes in. It's basically a word for how dramatic the price changes are. A low volatility investment is kind of calm and steady, but a high volatility one is a total roller coaster, which, yeah, could mean bigger rewards, but it definitely comes with bigger risks.
All right, let's level up a bit. We know the basic terms, we can read the market's mood. Now let's talk about the big picture ideas that smart investors use to manage that whole risk and reward dance.
First up, your portfolio. It sounds fancy, but it's really just the name for all of your investments bundled together. Your stocks, your bonds, your retirement accounts, all of it. It's the full snapshot of your investment life.
And what's the number one rule for building a solid portfolio? It's this timeless piece of advice. This is the whole idea behind diversification. You're just spreading your money out across different kinds of investments. That way, if one area takes a hit, it doesn't drag your entire portfolio down with it. It is probably the most important strategy for managing risk, period.
And that brings us to the grand finale, and honestly, the most exciting part. Why are we even doing all this? The end game is financial freedom. So let's look at the concepts that explain how your money actually goes to work to make you more money.
Seriously, if you only remember one thing from all this, make it this one: compound interest. They call it the eighth wonder of the world for a good reason. It is the absolute magic that happens when your interest starts earning its own interest. This right here is the engine of building wealth.
So how does this magic work? Well, it's basically a snowball effect. You start with your principal, right? That money earns some interest. But then, and here's the key, that interest starts earning its own interest. And over time, that little snowball just gets bigger and bigger, rolling faster and faster.
And this is not just some abstract theory. Look at these real-world numbers from the source material. If you invest $1,000 and it gets an average of 7% a year, thanks to compounding, it'll double to about $2,000 in just 10 years. And that's without you lifting another finger. That is literally your money making money for you.
So when you do make a profit, how do we talk about it? Well, there are a few terms for that. Your ROI, or return on investment, is just a simple way to measure how profitable something was. A capital gain, that's the specific profit you make when you sell something for more than you bought it for. And then there's the dream for a lot of people: passive income. That's money that just flows in with very little ongoing work, like dividends from stocks.
Wow, we have covered a ton of ground, from the absolute basics of assets and liabilities all the way to the incredible power of compound interest. We've translated the jargon, so the final question, it isn't for me to answer, it's for you. Now that you can speak the language of money, what are you going to do with your new financial voice?